While buying has alternated this week between growth and value, it was stocks that were deeply hammered, deep growth, deep value if you want to, that actually enjoyed the greatest revival, particularly those brick and mortar retailers. Even today, many of those names are up and better than expected earnings. Now, all of this creating a dilemma for investors. Do you buy the broken names with the most risk? Do you buy these growth names on dips? Do you simply hold value and hope one day they will come to life? Let's ask. We got some great ones for you here, including Rob Luna, CEO of SureVest. It's a CI financial company. Sam Blast Securities President Danny Hughes joins us, as well as Point View Wealth Management President and their Chief Investment Strategist, David Dietze. Danny, I got to give you a shout out. You were buying those broken energy stocks when the narrative was that we would never use oil again, right? So, for a while you took it. Every week you came on and said, I'm hanging in there, Charlie, I'm hanging in there. Now you're rocking. Do you still like them?
I do. You have to long term, because think about it this way. The oil industry and the energy industry got hit at every imaginable angle, right? There was a supply side shock, a demand side shock, all at the same time. And everybody decided that never again are we going to go back to fossil fuel energy. But the fact is that fossil fuels are the most dense fuels. So that means that they're the best ones to burn so that we can have energy in this country and all over the world. So, you have to think about it this way too, Charles. There's been a lot of growth in renewable energy and those kinds of things. And those are great companies to own. I own an awful lot of them. But with growth, you don't get that much on the dividend side. So we look for cash flowing companies with strong balance sheets that can come back in the age of crisis, which is where we are now. So we're seeing like West Texas actually is up 20% this month alone, beating the S&P, which was up 9%, which is very healthy itself. So we love those names. They came back very, very well. We continue to own them.
They have. And WTI, West Texas Intermediate, still near a resistance level. If it breaks out, a lot more room to the upside. Meanwhile, David, your letter last month was cautious. You talked about value. But, of course, here's the thing I'd like to help the audience with, because value is a word. It feels almost like a euphemism for so many things. It means different things to different people. So can you qualify exactly what it means to you? Give me a name or two that qualifies its value for you.
Yeah, absolutely. So what I like to call value now is dividend-paying stocks, because people need income now. We have no yield whatsoever in the fixed income market. Money market yields are close to zero. Historically, nearly half your return on stocks has come from the income paid out. They have beaten non-dividend-paying stocks. So that's my focus. And of course, I would agree with your co-guest. For me, value would include those energy names. I would say we are setting up for the mother of all comparisons. What are we going to be doing this week? We're all locked down. No one can visit grandmother or the kids. The flights are canceled. The car's in the garage. What's going to happen next year at this time? We're going to have two great vaccines. We're probably going to have a dozen more. People are going to be busting out to go visit. Fuel usage for cars and airplanes is going to skyrocket, and those are the stocks you want to be in. Chevron and Exxon with huge dividends.
The comparisons are going to be out of this world for sure. So what about the beaten down stocks or sectors? Rob, I want to go to you because ironically, both Danny and David mentioned dividends. Last week, you kind of cleared up this barbell term. I hate the term. Too many people are using it. I feel like it's nebulous. It just means anything to me. But you explain dividends. So you like this whole idea about dividends as well. Are there any beaten down names now, stocks that are still down a lot, that people might want to spy or look at for outsized growth?
Yeah, I think, Charles, to that point of the barbell, just to kind of reiterate that, it's combined the dividends with the growth. And to give you an example, playing with the oil patch, we like Enterprise Products Partners a lot right here. That's a stock that's yielding over 9%. We didn't get the blue wave, but with the Biden administration, there's probably not going to be a lot of new pipelines coming on. They've got a great balance sheet to sustain that dividend. On the flip side, we talked about last week, everybody was selling out of Zoom. We're buying that in the 300s. I actually picked up some more this morning at 427. We're going to continue to get these scares at least for the next quarter. And we also think long-term structurally, business travel is not coming back. Those are two names that fit that barbell approach.
All right, and EPD, not to be confused with the rap group EPMD, which had a whole lot of great hits. Hey, Danny, are you looking at anything on the tech side? And by the way, Zoom, the high is 588, so it actually is a buy on dip right here.
Yeah.
Right. I do. I mean, I like Zoom. I like watching Zoom. I like being on Zoom. I don't own it. But talk about beaten up names. Intel is one that we do own. We're starting to dip into and dip more into. And I know some people hate the name. They think it's a value trap. But this is a company with 6 years of dividend growth. They've got a long way to go in terms of management, hopefully restructuring and tweaking. But I like to buy things where I have to be patient and I get paid. And dividend is one, and Intel is one of those names where you're getting paid a dividend, you're getting paid to wait.
Yeah.
So that's a name that I'm looking at right now.
Something tells me you have a lot of stray dogs and stray cats at home. You are just so kind. Let me give you a trivia, folks. Yesterday, 0 stocks in the S&P 500 closed at a 52-week low. The worst one was Intel. It's 5% within its 52-week low. So you talk about bottom fishing. David, also in this whole tech space, it's not the names that we know, right? It's been chips, it's been cloud that's really done extraordinarily well. So not all tech is the same. Is there any specific niche there that you like?
You know, I hate to just be part of the choir here, but Intel's my name too. So I separate the techs between the stay-at-home techs, you know, some of the e-commerce plays and so forth, the Zoom, which we've maxed out on. We want to break out. And Intel, of course, is, someone put it the other day, the nuts and bolts of chips. What am I talking about? I'm talking about autonomous driving. I'm talking about artificial intelligence. I'm going to talk about robotics. There's huge tailwinds behind that. And as this economy picks up, I think there's going to be more and more demand for Intel. You've got not just a dividend, but a growing dividend, 9 times earnings. It seems like a low-risk way to take advantage of these tech trends, Charles.
All right. I don't know. I'm a little worried. I think NVIDIA and Advanced Micro might be eating their lunch, but you got to like the risk reward here. Let's talk about overall a little bit more of the macro picture. Estimates for the fourth quarter GDP have been trending higher, but JP Morgan out saying that it's the first major Wall Street firm that the first quarter is going to be negative. Let me go back to you, David. Is this changing any way at all that you may be investing in this market, the notion that because of these lockdowns, we have negative GDP in Q1?
Well, so I do think some caution is in order. We're up 65% since March. One of the 3 pillars that people were putting money into this market was for stimulus. And I think that with the divided government, I think the stimulus is going to be more cautious. Remember, lawmakers, they too are looking at these vaccines. So the good news on the vaccines means, hey, we don't have to spend as much of the taxpayers' money. So I think that could take a little bit of the edge off the rebound in Q1. Having said that, ultimately, it's the health that's going to drive it, not any kind of stimulus.
All right, I want to get a little bit more granular then. Let's go from macro to micro, because there's some amazing moves in this market, particularly with these electronic vehicles, and a lot of these Chinese names. For instance, a stock called Green Power Motors. Folks, if you haven't heard about it, it's an electric bus company, up 170% since October 28th, up 17% today, trading about 4 times its average daily volume. These names are just really blowing away so many other stocks. And I'm not sure, Danny, if it's just old spec players, because it feels like this falls into that ESG, you know, that socially conscious area. I know you're someone who follows ESG type principles. You see any value in these names?
I mean, you have to see value in the fact that, or maybe even growth. I don't know, when you talk about value investing or value in names, but I do see a lot more room to grow in the ESG space. And there's a lot of names to look at, but there's one that I wanted to bring up that ties in a bunch of these themes all together. So mobility, China, technology, solar. So new tech, NIU is the symbol, 24% growth in 2019, expecting 50% growth in 2020. This is a company that makes Chinese lithium scooters. So their biggest market is China. About 86% of their market is there. Stock is up 320% year to date.
And it's just getting going.
Cheap. It is not cheap, but at 88 times earnings. However, this could still have a lot more room to grow.
All right, well, we got to leave it there. Chinese lithium scooters, folks. It doesn't roll off the tongue, but Danny says it could make you a whole lot of money. Rob, Danny, David, always appreciate it. Have a great weekend. We'll talk to you next week.